Right, so now in this session I want to walk you through three valuation models. We'll talk about a couple others afterwards. Um, you should have seen at least one of these in your initial finance classes. Um, on paper 4 you have to use three models, and the models require, two of them require that your firm pays dividends. One of them just requires that your firm has positive earnings. So when you're picking your firm for papers 3 and 4, make sure you have a firm that is paying dividends, unlike, say, Google or Amazon that don't pay dividends, and make sure they have positive earnings. If your firm doesn't pay dividends but does have positive earnings, it's possible to get a number. Unfortunately, I would need the Bloomberg machine to get it. I'm not sure I will have access to Bloomberg, but it's possible. So if there's a firm you want to do that is not paying dividends, like a Facebook or a Google or Amazon, we can talk about it. It may be possible. There are some numbers we can substitute for the dividend that use these models. But for right now, there are models that use dividends. And the three models we're going to use, the dividend discount model, you definitely should have seen that one, also known as the Gordon growth model. And it's next year's dividends. We're going to actually use last year's dividends. And so what we're going to do is we're going to take dividend 0, which is last year's dividends, times 1 plus growth, and divide that by KE minus growth. So we're going to make one change. There's two ways you can do the formula. You can show it as next year's dividend, or you can show it the trailing 12-month dividends times 1 plus the growth. Now in the past, we've gotten these numbers from Yahoo Finance. Unfortunately, Yahoo Finance shows that they're using next year's dividends, but they're actually not. So I'm going to show you how to get last year's dividend very, very easily. So we'll actually be using this formula. Your growth rate must be lower than your discount rate. So if your discount rate is 6%, your growth rate cannot be 7%. Extremely important. I've had some students turn in papers where they get negative numbers, and I'll just tell you now, if your growth rate is greater than your discount rate, your valuation is not a negative number, it's actually infinity. So we're going to assume dividends and earnings grow at the same rate. That's not true for a lot of companies, but it's true here. We're essentially doing what's called a perpetual growth annuity. When I was valuing bonds, I showed you how to use a perpetual annuity to value the bond. So here we're doing a perpetual growth annuity, which means we're going to take the cash flow and not divide it by the discount rate, but take the cash flow and then divide it by the discount rate minus the growth rate. That's where the perpetual growth comes in. So I'll show you this model. The second model, this is my own. So in paper 4, it's very important when you use this model to acknowledge that it's my model and the theory. You have to say a few extra words on this one. On Gordon growth, you don't have to explain it because everybody knows that model is very common. Capitalized earnings, you need to explain that this is the model that you got from me. And the theory here is a firm pays out 100% of its earnings. If it does that, that is going to greatly reduce its growth rate. But I'm going to argue that if it pays out all of its earnings, it can still grow its earnings with inflation. And you can do the math. If revenues grow with inflation and expenses grow with inflation, then your net income will grow with inflation. I'm just assuming a firm that doesn't reinvest in itself. So it's a Walmart that doesn't build any new stores, doesn't expand any new markets. All they can do is grow their revenues with inflation, watch their expenses go up with inflation, and if they do that, their net income will go up with inflation. So essentially what I view this is a model that shows what's the value of the firm as is, without any expansion, any new growth, just what's the value of the existing firm. It looks a lot like the dividend discount model, except for instead of using dividends, we can use earnings, and instead of using the growth rate, we'll use inflation. But it's exactly the same. So we'll use earnings per share for the next 12 months, which is just earnings per share today times 1 plus the inflation rate. So you'll actually pull in the last 12 months earnings per share, and you multiply that 1 times 1 plus the inflation rate, and you'll divide that by discount rate minus the inflation rate. Some firms do get a higher value on this than they do on a dividend discount model because there's some firms that are paying very, very low dividends. As such, the dividend discount model or garden growth model gives them a very deflated valuation, and cap earnings can give a more realistic valuation. The last one is a model I really, really like. It's called the H model. It's a model I discovered in studying for the CFA exam 30-something years ago, whenever that was. Found it in the footnotes of a paper they had, and I thought it was really good. It's essentially the dividend discount model, but with this middle section. So if we take this middle section and cut it out, then you'll notice it's just a Gordon growth model. It's dividend 0 times 1 plus growth divided by KE minus growth. So what we do in this middle section is we take dividend 0 times a time, and we get one extra growth rate, the short-term growth rate. That's the growth rate today that is over time going to go from a high growth rate probably to a lower growth rate. You can start with a negative number and go to a positive number, but most people, like a Google or a firm that's growing really fast, maybe an Apple, you assume that their short-term growth rate is 10%, but their long-term growth rate is maybe 5 or 6%. The only question is, how long will it take them to get from this short-term growth rate to the long-term growth rate? And that's where H comes in. H, you can think of that as the half-life. If it takes 10 years to get from the growth, so let's say they start at 10%, and over 10 years they get down to their long-term growth rate of 5%, then if that's 10 years, then your H is 1/2 of that, or 5. In paper 4, you have to justify your H. I'll talk about that. That's one thing a lot of students just give up on and just don't put any effort into it at all. But you can see this is a formula that's extremely similar to the Gordon growth model. It just has this extra added period of time in there. All right. So what I want to do, now there are other models. The multi-stage growth model, I was actually taught this model, and I actually had a professor put on an exam. I thought it was ridiculous. Today with Excel and other things, memorizing a formula this complicated just doesn't make sense. I like the H model because it's a simplified version of these multi-stage growth models. All right, so before I go into the other models, what I want to do is jump out and value a stock using these 3 formulas. And the stock I'm going to do is Walmart. And so let me just show you the assumptions you need. And this, again, I'm going to do all of this again when I'll walk you through papers 3 and 4. So you'll see the entire thing again one more time. But I'm going to do Walmart. Oops. So what do we need? First of all, we need the discount rate. To get the discount rate, we need the risk-free rate. I'm just going to plug in numbers here for paper 3. You have to justify these numbers. I'm going to use 1.5%. I know 10-year treasuries are below 1.5%, and we want to use the 10-year treasury, but I'm going to use, to get a more realistic number, I'm going to use 1.5%. We need the market risk premium. I'm going to use a number similar to what we used. I'm going to use 5.5%. Again, you'll have to justify that in your paper 3, and I'll go through that in detail. We talked a little bit about it, but I'll get into more detail there. We need a beta. Well, this is Walmart. Remember, when you're doing paper 3, you have to go through those 4 steps. First, is a cyclical or defensive company. What is its operating leverage? What is its financial leverage? And look at the history. I'm going to right now just skip all of that, and I'm going to use a beta of 0.8. And that gives me a discount rate for Walmart, a KE. Remember, the formula is the risk-free rate plus beta times the market risk premium. And so I'll take the risk-free rate plus beta times the market risk premium. And that gives me a discount rate of 5.9%. That seems reasonable for a Walmart. It might seem a little bit low, but we're in a period of time now where the stock market is just not priced to give really, really high returns. So 5.9 is what we have. The next thing we need is dividend 0. Let me show you how I would recommend how you should do is dividend zero. So if you go to Yahoo Finance and you pull up your firm, you'll see your firm in Yahoo Finance, and there's a link that says historical data. So if you click on the historical data, it will bring up Walmart's stock prices historically, but it also shows their dividends. And when you do that, all you need to do is go back through this history. So as all this history comes up, you just slowly page down, and you'll notice they paid one dividend for 54 cents back in March. You want to go back the entire year. Then back in December, they paid 53 cents, so 54 plus 53. Keep coming down. Yeah, it's a little slow, but hopefully it will let me come down here. Yeah, it's still loading. Sorry, very, very slow. Sorry, my computer's slow, and I'm having problems with this computer. But if you go down over time, you'll notice they paid one dividend just recently for 54 cents, and the previous three dividends for the last year were 53 cents. There, now it's working. 53 cents, and there you go, 53 cents. So 53 cents 3 times and 54 cents 1 time. So if you do all of that, you get $2.13. So you just want to add up the last 12 months of dividends. If you click on the summary sheet, you'll see something that Yahoo Finance has started doing that I really do not like. I wish they would not have done this. I wish they would just show exactly what I had here to 213. But you see they show a forward dividend, and they show it as 216. How did it get 216? Remember, the last dividend was 54 cents. They just took the latest dividend times 4, and they got 216. So that's fine, but I don't want to use that number. I'm going to use 213 because that's what they actually paid the last 12 months. And look at the earnings per share, 519. So we can put those two numbers in there. Dividend zero, not 213%, but $2.13. And for earnings per share, we want to earnings per share zero. I mean the latest 12 months. And for that, we saw that that was 519. Now I need a long-term growth rate. And for Walmart, I don't think this is a high growth company. I'm going to use 4%. I'll talk when we get into this. I usually tie this to economic growth. I think economic growth will be 4 to 6%. I think Walmart is a very mature company, doesn't have a lot of expansionary things ahead, plus it's competing with Amazon and Alibaba, so I don't think this is a firm that's going to grow particularly fast. I need an inflation rate. Since the Fed's targeting 2%, I think 2% is a perfectly good number, even though we've been well below that. And then I need a short-term growth rate. Well, I might say, okay, well, we got the coronavirus. This is a great time for Walmart. They're really ratcheting up. Maybe it's temporary, but I'm going to give them a 10% short term. And we'll talk when I do the actual example how you get the short term. We talked about the 3 approaches. You can look at the history. You use the PEG ratio, or you can use the sustainable growth. I'm not using any of those here with Walmart. When I do the example for paper 3 and 4, I will get in more detail there. Then we need an H. The H is how long will it take for the firm to go from a 10% growth rate to a 4% growth rate. And the way the H model works, they don't grow 10% year after year after year and then suddenly start growing at 4%. It actually takes the 10% and gradually reduces it down to 4. I'm going to say that's going to be 3 years to get from short-term growth to long-term. Boy, this keyboard is so bad. Well, if it's 3 years, then your H is 1/2 of that, or 1.5 years. And then we just start valuing them. So the dividend discount model, very simple formula. You just take dividend 0 times 1 plus the long-term growth divided by KE minus long-term growth. And we do that, I take dividend 0, 213, times, or parentheses, 1 plus the long-term growth divided by KE minus long-term growth, and that gives me $116.59. The capitalized earnings model, I'll call it CEM here. It's exactly the same as a dividend disc model, except for we don't use dividend 0, we use EPS, earnings per share 0. We don't use long-term growth, we use inflation. But other than that, it looks exactly like the dividend discount model. It is a constant growth type of model. So when I do that, I'll take earnings per share 0 times 1 plus my inflation rate divided by KE minus my inflation rate, and I get $138.40. So you can see with Walmart, the capitalized earnings model actually gives you a higher valuation than the dividend discount model. And not sure if I did something off here. Oh, I have an error. You notice, hopefully you saw my error. I accidentally used C9 for the growth, and it should have been C10. So sorry about that. So you want to take earnings per share times 1 plus inflation. I could tell I was off a little bit there. So there, that looks better. And then the H model. Here at the H model, again, it looks just like the dividend discount model, except we're going to add this middle section in here. We're going to take dividend 0 times H times short-term growth minus long-term growth. We just add that into the middle. Let me make sure I've got it correct here. Plus, it's plus that. So we'll take dividend 0 times 1 plus the long-term growth, close parentheses, plus parentheses, close parentheses, then plus dividend 0 times H times, open parentheses, short-term growth minus long-term growth, close all of that out, divided by KE minus long-term growth. And I get 126.68. The current price, and we'll talk about what to do with the current price later. If you go back into Yahoo Finance, the current price is 109.40. So I might have a buy on this stock. It's not a real strong buy. There is some upside here. We'll talk about how you can actually talk about your buy sell recommendation in your paper 4. There's some things you can do that are really effective. I just want to introduce you these formulas. So again, when we get into the example for papers 3, I'm somewhat delaying that so you can get ready for the exam and get your paper 2 done. So I want you focusing now on paper 2 and not on papers 3 and 4. So when I do the video for 3 and 4, you might watch it and leave it to the side, finish paper 2, and then come back to it. So what we'll do next session, so this finishes up this class. So we had 3 sessions for this class. We got through the models. what I want to do in the next class is we'll start here. I want to show you what I call a proprietary quantitative model. And then I want to give you a few other models, the free cash flow model and the contingent claims model. Walk through those. We'll then get into relative value analysis, which is a really, really important topic as well. So we've got some great topics here coming up, but I'm going to leave it there for the day. And the next class we have, we'll probably get into relative.